This is TreppWire Week in Review for week ending January 13th, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. And joining us is Orest Mandzy, Managing Editor of CRE Direct News. This week, investors digested the big economic headline, the release of the December consumer inflation number that logged its sixth monthly decline. And this was on the heels of a strong December jobs report that also showed wage growth slowed. Manus, stocks gained later in the day after investors dug into the cooler inflation number and what it really meant.
Yes, it was well received, although the move in stocks was not violent as we've seen after several CPI reports in 2022. Some of those violent moves were down and some of those violent moves were up in recent months, right, going back to early 2022. So the headline number pretty much in line with estimates. The core number also very much in line with estimates. The take after the fact was muted but positive. And by that, I mean stock futures were up in the immediate moments after the announcement. Other than a dip mid-afternoon, New York time, stocks, the major indexes were all firmly in the black, not overwhelmingly up, but a rally is a rally. In terms of the reaction, I would say the reaction underscored a narrative that we can get away with, we being the US economy and the Federal Reserve, one or two more 25 basis point hikes and then call it a day. That narrative got a lot of steam on Thursday and bond yields tumbled. So we saw the 10-year hit its lowest level in about a month and a week or so, 5 weeks. It was down to 343 by the end of the day. The 2-year was down to, I think, 412 by the end of the day. So it's rapidly approaching that 4% threshold again. All good news there for those that originate loans, people that are looking to refinance, a positive report there. If there was any blowback on the report, I would say it was a couple of items that when people really scratched beneath the surface, and maybe this is people that always are looking for the rotten egg in the batch of 12, I don't know, but the services element of the report was a little bit hotter than people were hoping for. And there were some analysts out there that were saying that that might be cause for the Fed to disappoint us and keep rates higher longer or come up with more rate hikes than we expect. We'll see. But by and large, a good day for the data, a good day for the market reaction, and a good day for the commercial real estate market, given the reaction in rates.
Yeah, so if we dig into some of the good news on the inflation front, Manus, at a granular level, gas prices fell, helping to hold down headline CPI. If you look at prices at the pump, they're down about 9.5% for the month and about 1.5% from a year ago. And grocery prices have slowed. They only rose 0.2% December, which is the smallest increase in the last 2 years. So, maybe while the services number was not great, there's some good news when you dig a little bit deeper as well. Obviously, the rent data still showed to be increasing, but we've talked about some of the challenges with using some of that older rent data in the calculation. Some interesting comments from some of the Fed folks. We've talked a lot about Bullard and kind of what he said over the last couple of months. I think he reaffirmed the central bank's position that rates, and I think his quote was, would need to be north of 5% by the end of the year. And so it'll be interesting to see what happens there. Philadelphia Fed President Patrick Harker said that the Federal Reserve should raise its benchmark rate slightly above 5% and then pause. It feels like they're not backtracking at this point, but I think on the whole, today's news has to be pretty well received from all of us in the marketplace.
Well, you look at the 2-year for a long time. For several months, the yield on the 2-year was well above what the current Fed funds rate is. And now what you're seeing, especially if we get another 25 basis point hike, the 2-year will be below, or maybe already is, what the Fed funds rate is now, which tells you that traders, investors, money managers, et cetera, are looking at this as, an inflection-y moment, right? That we've gotten to the peak rates at this point, and coming out of this or the foreseeable future, we're not going to see that 5 or near 5 2-year again, or that 4.5% 10-year. Things can change in a heartbeat, as we know, with inflation. We've seen that before. But I tend to feel like perhaps the worst is behind us, with regard to food prices and energy prices and so forth. Let's keep our fingers crossed that that's the case.
Well, the Fed's been watching the labor market as well. That's been kind of their secondary focus. And, while the employment market remains strong, wage growth actually slowed a little bit. So average hourly, earnings slowed to about 0.3%, which was down from a revised 0.4% in November. So maybe we're starting to see a little bit of cooling off there, which hopefully bodes well.
Yeah, I forgot we didn't really have a podcast since that jobs report. So that was another, a nice indicator. It was kind of a Goldilocks number where we saw, decent job numbers in terms of new jobs added, but to your point, Lonnie, not with the really steep increase in wages. So that was a nice piece of data as well.
We did also see, and we've been tracking what's been going on in the housing market and continued softness in that market this week.
Yeah, so it seems like the last 2 months, every podcast, we've been giving an interest rate update on the 30-year fixed rate mortgage. So fortunately, we're going to disappoint a few of you that have gotten used to that. Today, we're not going to talk about interest rates, but we are going to talk about KB Homes. They reported revenue and profits, which missed estimates for the fourth quarter, tied to some interesting nuggets here. So net orders plunged, backlog fell 25% against the same quarter last year. And if you look at their gross orders, they fell 47% during the quarter. And the number that I think sticks out most is their cancellation rate as a percentage of gross orders totaled about 68%. Now, when you compare that to where they were a year ago, they had a cancellation rate of 13%. So, that's not great news, and maybe is indicative. Obviously we're talking about KB specifically, but I would think would probably be fairly indicative of what other like type builders saw in the marketplace. And they delivered about 3,800 homes in the quarter. So that was some good news. It was up 3% compared to last year. And the average sales price was just over $510,000, which in another bit of good news was up 13% year to year. So sales price, they've, haven't seen dramatic cuts. They've actually seen increases. But that 68% cancellation as a percentage of gross orders isn't sustainable for them long term.
Yeah, it'll be interesting to see if and how elastic demand is in housing, right? We knew the bubble burst very quickly when rates shot up. The demand fell very quickly. Cancellations spiked. Pending home sales fell sharply and so forth. So we know that there was a lot of elasticity on the way up. Hopefully, there's some elasticity on the way down, right? I'd have to think that mortgage rates are now about 75 basis points or so below, maybe more, maybe even 100 basis points below their peak of the middle of 2022. So we can only hope for that, right? That we see that same elasticity on the way down. And it could be a good time, right? We're going into home buying season. People like to buy homes in the spring. We're about 2 months away from that. And buyers may get a nice tailwind, the combination of prices that are down considerably from a year ago and rates that are down maybe 100 or 150 basis points from their peak. So maybe we do see that snapback come the springtime.
Well, I think we've seen some interesting incentives announced over the last couple of weeks. I've seen several home builders that are, willing to buy down the interest rate for anyone that buys some of their new construction homes. Or I even saw a commercial for Rocket Mortgage the other day. It was saying they would do an introductory, interest rate relief program. Basically, they're buying down the interest rate for the first couple of years of the term, hoping rates come down and people will refinance it to different, loans. So, I think with what you've outlined, man, is, seems like March, April, May are the busiest months for new home sales or for home sales generally. So hopefully some good news heading into that buying season.
Yeah, Dan Gilbert, right? He's the owner of Rocket Mortgage, and I think he also owns the Cleveland Cavaliers. You can get a call to your home from the backup point guard of the Cavaliers if you lock in a mortgage in the next 30 days, something like that, But I did hear that. I have a family member who's in the construction business, and he said one of his competitors had the foresight of lining up a lot of debt when rates were 3%, keeping it on the sideline for just this moment. And now they're deploying that debt to issue their own lower interest rate loans than what the market is. So they have a built-in advantage, and their size allowed them to do this, to perhaps offer, a 475 mortgage in a 6.25 environment. So some smart thinking there, but it'd be great to see people get back to a point where housing becomes more affordable.
So this past weekend and week, we all were at the Commercial Real Estate Finance Council annual Miami event, where lenders and other market participants meet to discuss industry trends, topics, and what to expect for the coming year. And let me say, what a difference a year makes after having attended last year in terms of sentiment, attendance, and some of the overall takeaways.
Well, for those that don't recall, this time last year, we were in the throes of Omicron, the variant that came out in late 2021. CREFC was expecting 2,000 plus attendees last year. When the Omicron came out, the actual attendance, I guess, was about similar, but 75 or 80% of the people did it virtually. Only about a fourth or a fifth of the people were there in person. And it was quite nice for those that came, and several of us were there last year because it was much more intimate and you could have more detailed conversations. But this year, it was the first one that was fully attended in 3 years. The last time we had a 2,000 plus person in the hotel conference was 2020. And I just have to say, it was incredibly restorative, getting to meet people in nice weather, even though the market is not great. And let's face it, 2023 is going to be challenging. We'll talk about that in a moment. The mood just seemed much more upbeat than I thought from a series of industry segment participants that had kind of taken a fastball to the ribs in late 2022. I think it was less doom and gloom than I thought. And it was just great to be there and to see everybody.
Yeah, so I was introduced to a new concept at this week's conference. It was a combination of the words cautious and optimistic. So everyone's theme was cautiously optimistic. And I pondered if that's like reasonably certain. And so it's kind of an interesting construct that there's storm clouds, but I think behind the storm clouds, people feel like there's real opportunity. So depending on which side of the ledger you're on, the next 6 to 12 months are going to be really interesting for people looking for some distressed deals that maybe didn't come during COVID. I think there's a sense of optimism that they're going to be able to finally transact at prices that make sense for them and maybe scoop up some really good assets in great locations that have for the last few years been priced out. I think for folks holding the note on these, there's a different type of anxiety building in the sense that there's a lot of loans set to mature over the next 2 years. And, the central themes, or takeaways where no one knows what the value is. If it's an office building, no one knows what the future use of that building necessarily is going to be. If it's malls, they're still challenged and nobody really knows what the Fed's going to do. So I think, that's where the cautious came in the sense that, Brian Bailey was there on the industry roundtable. And I think he was pretty adamant that the hawkish tone of the Fed is going to remain, even if there was a good CPI print today. And if you look at the other experts in the field, there wasn't really a lot of agreement in terms of how much value's been lost, if there's a huge delta between the private markets and the public REITs, or which one is more accurate, or where values really are. And I think until somebody takes that first mover and, says we're going to liquidate at price X, we're still going to be in a little bit of a stalemate. So I agree with you though, Manus. It was great to see a bunch of people back at the conference. And I think the general mood and feel was actually more optimistic than I thought, given kind of the macro backdrop.
Orest, let's go back to you for a minute. When was your first conference for CREFC? How many years have you been doing this? How many cycles have you been through?
Too many to count.
What was your takeaway from this compared to, we're not in a crisis right now.
Right.
Let's face it, it's going to be tough to make money for a lot of people this year. We've seen downturns in 08, in 15 and 16, and the beginning of COVID for sure. What were your takeaways from this conference?
So Lana used the words cautiously optimistic. I was going to say folks were cautiously pessimistic, right? So the thinking right now is that values might be down 10, 15%. Some folks said, they're probably down as much as 30% because nobody knows. Revenues might be increasing, but costs are increasing tremendously as well. Particularly in the multifamily side, you've got higher insurance costs, higher tax costs. So what are valuations was the big takeaway from the entire conference is nobody knows what the value of a property is right now. And that stabilization of interest rates, the hope is, will kind of allow some actual price discovery to happen. Another couple of words that I learned, it's not rescue capital anymore. It's called recovery capital, with the expectation that your property might be pressured to get refinanced. So you're going to need to bring in either mezzanine debt or preferred equity. Folks are gearing up for that. Spoke to a few folks who have developed capital and have it ready. People keep on saying there's plenty of liquidity in the market, but if it's in the bank, is it liquidity?
That's like that euphemism that people say, I'm a mature gentleman, not an old man.
Yes.
That's in that similar vein.
I echo a lot of what Orest said, and it depends on who you talk to, really. I felt that there was a little bit of whistling past the graveyard going on, and the L word came up, and not in a positive way. The L word's the liquidity word, right? We've heard that there's plenty of capital, and I think for the first time you heard people saying, well, but if you have exposure in an asset and you're maxed out at that particular asset, you're not going to go after it. So it was interesting. And I think the reason there were so many people there was they were looking for some information and direction as to what was possibly going to happen. The problem is the Fed has some of the answer there, and there's not much that we can do to control that.
Yeah, my takeaways, I'll go through just a couple more. They do underscore what all three of you had said. A couple of thoughts. Lonnie said this, not as negative as we would have expected. Definitely agree with that. To Mars's point, we're not as liquid as people think we are, even though people are talking about and pointing to the huge sums of money out there to buy distress. Unless you're willing to deploy it, and people don't seem to be willing to deploy it right now, they're waiting for another leg down, you're not all that liquid. And then lastly, I would call this the fastest transition I have ever seen from a new metaphor to a tired cliche. And that is, it's a game of chicken, right? Right now, the sellers of properties have their price, the buyers of properties have their bid, and they are light years away from one another. And who's going to blink first? Is the seller going to bring down his price and lower his expectation, or is the buyer going to raise his or her bid to meet halfway or higher? But that game of chicken came up over and over again. And by the end of, the conference, I grabbed 2 Chick-fil-A sandwiches and hoped I never heard the term again.
One thing that someone pointed out, because a lot of the loans that are maturing now were written 10 years ago, relatively conservatively, it's not an equity story as it was in prior downturns, but it's rather a debt story. Borrowers will need additional capital to sort of buy them time and stuff.
Yeah, and I think the sentiment kind of lined up with what you've been outlining the last few months, Manus, about just kind of a shallow recession. I mean, it seemed like, the number of people that raised their hand in terms of, or they think that we're going to be in a recession in the next 6 to 12 months were, a majority. But if you went outside of 12 months, that number dwindled really quickly. So like they're feeling pretty optimistic about the overall economic strength relative to us having a recession. So I remember it was probably like 2019, maybe it was 2018, 2019, seemed like malls were toxic. Nobody wanted to touch a mall, and even lodging had kind of fallen into that category where lenders were really staying away from those two assets. And I did get the sense here, like it was pretty universal that anyone that brought up office or any of the brokers that said, hey, we have an office property in a great location, great sponsors or whatever, there seemed to be some trepidation around the ability to get capital for those assets. So I think it'll be interesting to see what happens there, as this just starts to unfold. A lot of talk about adaptive reuse, but again, kind of talking points. Like I don't know necessarily that anyone has like a strategic plan in terms of how to do that. And the other thing that I thought was interesting, some people pointed out that hope's not a strategy. And a lot of people are kind of just sitting on hope that either the Fed reverses, hope that something happens and the government intervenes or whatever. So I thought that was an interesting takeaway as well.
I did meet a woman at the first night cocktail party on Sunday, and I won't share the name for reasons that will become obvious in a moment, but we were talking and she was mentioning to me it was her first CREFC, and her firm was an active investor in offices and was looking to get a lot more active in offices going forward. And the image that got through my head was, if that got out at that cocktail party, it would have been like the Beatles running across the tarmac with, throngs of people chasing them in the 1960s, and that's the reason I won't give up her name or her firm. I don't want her inundated with broker calls after this, but there are people out there, I guess, that, see appetite for this. I think in her case, it was mostly secondary and tertiary markets, which are a lot different than San Francisco and New York. And the bid is there at times. So
everything has a price.
And Lonnie moderated an event, the Multifamily and Affordable Housing Session, which had some very interesting takeaways.
Yeah, so this was an interesting session in the sense that we talked about multifamily generally, so conventional, just state of the market, and really delved into some of the affordable housing concepts and financing structures and kind of what that market looked like. And then we finished up with looking at, single family rentals and build to rent opportunities. And so I think when you wrapped all those things together, gave a really comprehensive view of the multifamily landscape. Some of my takeaways, obviously, I'm a little partial because I was on the panel, but I know Orest was in the room, so he can probably give from an attendee's perspective what this looked like. But there was definitely some consensus around uncertainty around cap rates, although there was consensus that cap rates have gone up. They just don't know how much, and it's market dependent, and multifamily has been impacted less than some of the other asset classes. Definitely some consideration for like multifamily being stronger than the other commercial asset classes. I think there was general optimism around at least the panelists in terms of the availability of financing, strong fundamentals. I mean, we're talking about underwriting changes, maybe to vacancy 50 or 100 basis points instead of, significant like we've seen across some of the other asset classes. One of the challenges, though, I think everyone was having trouble saying how they're dealing with them is just some of the expense side. So insurance was a hot topic for obvious reasons, especially being in Florida. I know in that market, there's been significant increases in insurance costs, labor costs up dramatically. And so it's interesting to see, are those long-term systemic costs? Are those things that are just a byproduct of kind of where we're at in the marketplace? And then on the affordable side, we learned about the two types of affordable. They called them little a affordable and capital A affordable, which I thought was kind of interesting. But it seemed like general optimism there, shortage of availability, needing to build a lot more units, and some of the government regulations and some of the challenges that developers have in getting those actually on the ground. So I don't know, Orest, you were in the crowd, couldn't see you out there, but if you wanted to share kind of what your takeaways were, I think it'd be great.
So you mean the light wasn't reflecting off my bald head enough?
No, couldn't see anything from the stage.
Yeah, you pointed out affordable housing. It's all a supply and demand issue, right? We've been undersupplied since 2008 at least, and that's 10% of the housing stock in the country becomes obsolete every year. Something I learned at your panel. And that's where the alternative lenders come in. They provide the capital to make what otherwise would have been obsolete properties into okay multifamily housing. The affordable housing thing, I had no idea the private equity companies were the biggest owners of affordable housing in this country. And it stands to reason because they could be the highest yielding properties, I've been told. So it's kind of interesting stuff there. And again, this year is going to be challenging. The thinking is we're going to see negative absorption in multifamily nationwide, but things should turn after that as household creation is greater than housing starts.
Yeah, so back in my younger days, I actually managed low-income housing tax credit properties on site, and the owner that I worked for owned a bunch of conventional Class A multifamily. They actually preferred the LIHTC stuff because on the 4th of the month, they were getting a direct deposit from the government every month for a large portion of those rents. And the expectations of tenants from amenities and other things were a lot less on a relative basis. So definitely a compelling opportunity in some of those programs to buy assets that can actually produce really high yields. And if they're managed well and you do provide really good services for the folks living there, you have very loyal tenants that hardly move out. I mean, we had, 95% plus occupancy the whole time I was there and very minimal turnover. So I think affordable housing is an interesting subset of the marketplace. And to your point, Orest, like just not enough supply. John Palmer was on the panel. He actually had some really good stats around a lot of the new construction stuff that's coming online. And if you look where those assets are being built, in those markets, they're grossly underhoused. And so they don't have enough available housing units, whether it be single family or multifamily. So his supposition was that they were going to be absorbed with not a dramatic hit to rents, maybe some softening in rents, but the idea that over the next couple of years, those units will be absorbed and those markets will still stay relevant. It was fun hosting the panel. I enjoyed being a moderator, and I'm glad that you were able to take a few things away from it.
We also released our year-end magazine that Orest is the leader of wrangling all the folks that contribute to that, which is no small feat. We have a number of Trepp analysts and outside third-party contributors to that. It was a hefty document this year at 54 pages, but really good content.
Thanks. Yes, it was heavy. I could only take two on the plane with me. Otherwise, I would have breached the weight limit. So a few takeaways. We saw CMBS issuance decline by more than a third last year to about $70 billion. That's private label, not including CLOs or agency deals. CLO issuance was down also about a third to about 30 billion from 45.5. Last year was kind of interesting. You could track issuance closely to rates. So we started the year kind of strong. In February, we had about $12 billion of issuance, but then it started declining rapidly. And so here's some numbers: 1.76, 4.10, 100, and 208. So 1.76 is a 10-year treasury yield in January, and 4.10 is the 10-year treasury yield in November. Spreads for long-dated AAA bonds, for conduit long-dated AAA bonds, 100 in January and 208 in November. So you can't profitably originate and securitize loans, which kind of explains the sharp downturn in volume last year. Some folks have called what we're in right now a slow-moving liquidity event, where banks and alternative lenders are kind of not eager to lend unless they get repayments. Nobody wants to write new loans unless they get paid back money, which is all spelled out in our year-end magazine.
I don't think the full year numbers do justice to just how severe the drop-off was. I think you pointed this out to me in Miami, Orest, that at the halfway point of the year, we were still above 2021 year-to-date issuance, and 2021 was a great year. And then we just fell off the cliff in the second half of the year. And, I think that if we were to take the average of the first and second half of the years last year, and that became our baseline in the first half of 2023, I think people would be doing high fives and backflips, right? But if the new baseline, at least for the next 6 months, is what we saw from, let's say, September to December, it'll be difficult for originators, issuers, and so forth to make money, right? That will be the challenge for the first half, at least, of 2023.
You need rate stability to profitably write and securitize loans. And until we get that, folks just won't write loans for CMBS.
Yeah, for those that are new to the podcast or don't really follow finance very much, commercial real estate finance, what Orest was just saying was from January to November, we saw a 225 basis point jump in interest rates on the Treasury side. Lending spreads are a combination of your Treasury yield and the risk spread over Treasuries. That jumped by another 100 basis points. So all in, your cost of financing over a period of 11 months jumped by 325 to 350 basis points. So, you could see why that slowdown that Orest was pointing out took place.
And there's a number of other articles that include, I like this topic, office loan maturities, drama thriller, or chainsaw massacre, probably one of the more creative titles that you had, but other topics about self-storage, defeasance, special servicing, and others.
I'll give credit to Stephen on that one, Stephen Bushbaum on that headline. We're not as pessimistic as the headline might indicate, but things could get ugly.
And if you want a copy of the magazine, it is free and available. So if you give us an email address to send it to, we'd be happy to send you the PDF and you can peruse it at your own leisure. But there's a variety of topics in there that we probably don't have nearly enough time to go over.
And if you want a copy that's inscribed and signed by Orest, that too is free, but it'll be suitable for framing.
And let's look at the December 22 loan payoff report. We periodically will cover this in the pod.
Yes, this is something that we put out every single month. We don't always talk about it, but we've been covering it for about 10 years now. One of our long-standing clients suggested we track this maybe even more than 10 years ago. and we have been ever since. What it reflects is the percentage of loans that reach their maturity date and fail to pay off on their balloon date. It strips out loans that were paid off early. It strips out loans that are already distressed when they get to the maturity date. So it is really for those people that buy front-end AAA CMBS bonds and IOs, so they can get a sense of how quickly the loans will pay off. And if there is risk to the AAA holder for extensions, you don't want to be holding a below rate coupon if it extends for another 2 years, or if it contains upside for the IO holder in the form of getting extra cash that you didn't intend to get. And if that didn't make sense to you, by all means, email me or reach out on LinkedIn. But in the past month, in December, only 39% of the loans that reached their maturity date paid off on time. So more than 60% of the loans, and this is about a $1.2 billion data set that was maturing last month. Of that, 60% didn't pay off on time and moved into CMBS purgatory. The biggest one in that category was the $240 million Republic Plaza loan. That's a big office tower in Denver. So, and it's of a piece, right? 38% of the loans paying off, 60% not paying off. If you have low coupon debt with negative equity in the property, and you're in a market that people are not dying to lend to you, that is ripe for going into CMBS purgatory and or negotiating a longer term, 1, 2, 3 year extension.
And we're going to cover a couple of property sectors this week. We're going to start with retail, which of course you saw the Bed Bath & Beyond news about its cost-cutting strategy, including store closures and layoffs.
So yes, the first piece of news this week was it came out on Bloomberg and CNBC that there were reports that the firm may not make it as a going concern, which means a bankruptcy filing is possible. If that does come to pass, you're never really sure what happens. In some cases, retailers reorganize and come back. They shed leases and they reduce their store count, but otherwise emerge as a going concern. In some cases, that's the end of the road. Going back 20 years, firms like Circuit City and Borders Books and Caldors were among those that never emerged again. In the last 10 years, Bon-Ton, Sports Authority, and Toys R Us also fell into that category. So what happens to Bed Bath & Beyond, we don't know. In the latter half of the week, the firm announced another 60 store closings or so, pushing up the number to about 125 year to date. Our own Steve Bushbaum and Emily Yu and Jen Spillane did the heavy lifting of going through and seeing which properties had CMBS debt on them. That will be in our TreppWire 6:30 a.m. report tomorrow. So you can see that there.
But there is some good news.
Cheap towels.
Beyond the liquidation sales, which are coming. I'm going to go in there and buy some of those store shelves, those really heavy metal shelves. I don't care about the goods. Five Below, which is the 2023 version of the dollar store, I think, has a triple-double expansion plan. When I saw that, it reminded me of Manis's lifetime achievement in the Intramural Sports League, where his nickname was Triple-Double, because if he walked in the gym, you knew that's what you were getting. So they're going to triple their footprint and double its revenue. Plan is for them to open 200 new stores in 23 and then convert an additional, 400 existing storefronts to its Five Beyond format, which are items that are priced slightly above the traditional $5 threshold. So it's actually really great marketing. You have the Five Below and the Five Beyond. And if you're looking to find some of those storefronts, I have a pretty good idea where you can find about 125 of them here in a few months from the story we talked about just a moment ago. Yeah, we'll see if this plays out, but Philadelphia-based discount retailer, they made the announcements. This is good news for the retail sector. If you've never been in a Five Below, definitely not a place you want to take your, 7 to 12-year-old kid, because they have a lot of gadgets and stuff in there that are only $5 each, but they add up pretty quickly. So
Lonnie is being much too kind. My nickname was the triple single guy, and it wasn't a positive term. People have probably heard me say this on the podcast before. In our 35 and over basketball league in Westchester, I was good for one missed layup, one turnover, and one missed free throw per game. So I was Mr. Triple Single.
And we've got a couple more stories in the retail sector around mall space.
So yeah, just a couple real quick. The first one is what goes around comes around. This one comes from Commercial Observer. 5 malls were lent a total of 160 million, 5 separate malls and 5 separate loans. The lender was Stonehill, which is an affiliate of the Peachtree Group. 4 of the properties are owned by Cohan Retail. Listeners will know they've been an acquirer of malls in recent years. The malls in question, many were in CMBS before, and the new debt is substantially lower than the CMBS debt on the property from years ago. So, for example, the Greenwood Mall in Bowling Green, one of the Cohan assets, got a $42 million loan. That property once backed a $63 million loan that was part of a 2012 deal. The Cumberland Mall in Vinland, New Jersey, they got $28 million worth of new debt. That property once backed a $52 million CMBS loan. And a third property, this was a loan that was not made to Cohan. It was made to Fourth Dimension Properties on the Bellis Fair Mall. That property once backed a $93 million CMBS loan, and that loan was resolved with a $26 million loss. The new debt on that loan, $24 million. So what's the takeaway here? Takeaway number one is these distressed mall owners are now finding a way to get financing. That's takeaway one. So if you're in that mode, if you're thinking about buying a distressed asset, the fact that it was distressed once before is not a reason that it can't get financing at the right level. The other takeaway is that there are people out there willing to lend. You know, it may not be a very deep pool, but there is an appetite here and there.
Yeah, just a little bit more on the mall stuff, man, is we're actually working on a piece now for super regional mall data. So just to tease a little bit of that out, if you look at loan vintage from 2010 through say 2016 on issuance, the average appraised value on these assets are down about 60%. And if you look at them by square footage, malls that are less than 300,000 square feet are down about 70%. And then if you look at what their cap rates are compared to what they were in place at origination, it's strikingly different. So we'll have more to come on this. It'll probably be a couple of weeks before this is released, but something that we're taking a little deeper dive look at.
Let's turn to office. And with everyone trying to get a sense of where office is headed, you saw the story that Walt Disney is now asking workers to return to the office 4 days a week starting March 1st. So it's a little bit of a change from what many companies are doing, where they're in the office maybe 2 to 3 days a week.
It's a great sign. I think in New York, a lot of the brokerages are back full time. We've heard stories about some banks saying people can work from home 2 days out of an entire month, but otherwise have to be in the office. You know, the office space in many cities is beleaguered right now, and we'll get into that momentarily. But I think this is great. You know, it'll be funny to see, you know, we all have this perception or question among ourselves. You know, when people are not in the office, are they as efficient and are they working consistently when they're at home? And I think if we see a thinning of the herd of the people hanging outside of Times Square offices in the Elmo and Walt Disney character costumes, we'll know that some people were double dipping.
And you teed up and teased our Sublease special, which we're going to have to cover a couple of different cities that we've seen stats on their leasing volume.
Yeah, a couple of things out there. The first one from Jack Rogers of Globe Street. He reported that Manhattan office leasing was down 43%, and that's even, that's from Q4, by the way, 2022. That was even though Fox had signed that 1.2 million square foot renewal last year. Also in the same vein, Isabella Farr of The Real Deal noted that the LA office market ended 2022 with leasing down 19% year over year from Q4 2021, and availability had reached a new high. Previously, we had mentioned a report in San Francisco in a previous podcast that there was a 33% availability number. And out in Seattle, Rick Morgan and Mark Stiles continue to report on sublease space in the Puget Sound region swelling considerably in the fourth quarter.
The same is true in Chicago. Record levels of sublease space. 6.8 million square feet of office space is available for sublease. That's 106% up from a year ago, which is just astonishing.
Yeah, and I don't think we've actually seen rental rates recalibrate to all this sublease space. And so, that doesn't bode well for the office sector going forward, is at some point, all of those existing contract rents are going to get renegotiated down upon expiration to the current sublease or less than the rental rates in the marketplace.
Landlords are competing against tenants for tenants.
Unfortunately, we're going to run through crab and green in the office space now. And the crab is going to outpace the green by a wide margin. And it feels like every CFO and CEO, their New Year's resolution was to shed space. And we'll run through these very quickly. I'll start with the crab. Sarah Clearman of the San Francisco Business Times. Visa has placed 100% of its space in Palo Alto up for sublease. It's at 385 Sherman. That is a 64,000 square foot office. Also in the San Francisco area, this is also from Sarah Clearman. In fact, she has a TreppWire Podcast hat trick today. We're going to call on her 3 times. We call this one, Lily, Please Call the Office. AT&T has listed another 262,000 square feet of space in San Ramon for sublease. It's a property at 2600 Camina Ramon at Bishop Ranch. In the story, she calls AT&T a motivated sublessor. AT&T had previously offered space at the same property that was picked up by Chevron 2 years ago. Chevron took more than $300K at that property. Closing out the Sarah Clearman segment of the podcast, software provider Rimini Street has listed 70,000 square feet at 6601 Cole Center Parkway in Pleasanton. So that's all out in San Francisco. Also in San Francisco, but not from Sarah Clearman. This one's from Laura Waxman. Autodesk has put up 73,000 square feet of space for sublease at One Market Plaza. That's an interesting loan to watch. Earlier, Visa had announced that it was leaving that property. Also, Visa had 10% of the space in that property. The loan matures in 2024, and that will be one we're watching closely next year. And that closes out the crabgrass part. I'll let you guys weigh in on that before I let people close out the office segment with some greenies.
Well, I think what we need to do is have Haley order some TreppWire Podcast hats now, since we've had our first hat trick on the pod. And so we'll have to send that out maybe to Sarah. But, I think, I'm not surprised by any of this. I think this is where we're at in the market. And I wouldn't be shocked if we continue to see this type of activity over the coming months. I mean, especially as earnings come in, when these costs are fixed and they have an opportunity to maybe downsize and shed some of those on a dollar for dollar basis, it's hard for them to find that type of capital or cost savings any other place. So I think we've seen employers have been reticent to let people go based on how hard it was to hire them over the last couple of months. And so it seems like the easier option maybe is just downsizing and cutting some of their costs on the real estate portfolio side.
So I have 3 greens and 3 greenish mixed greenies. So here we go. On the green, several people reported this, but we'll give it to Jack Rogers of the Globe Street. That's the article I have in front of me. KKR is taking about 220,000 square feet of office space that Meta declined to renew at 30 Hudson Yards on the west side of Manhattan. KKR will now be up to almost 500 or a little over 500,000 square feet at that 55 Hudson Yards address. You could even call this one greenish, not completely green, because at one time KKR was looking for considerably more space in a new development, but nonetheless, 220,000 square feet of new space is nothing to sneeze at. According to the Boston Globe, I don't have a byline for this one, but it appeared today, GlaxoSmithKline is quintupling its space in Cambridge, Massachusetts. The pharma firm will go from 40,000 square feet of lab space to 200K at 200 Cambridge Park Drive in Cambridge. In the Los Angeles area, this comes from LA Business First, the Ontario Airport Tower in Ontario, California, has been sold for $39 million. It backs a $27 million CMBS loan. The collateral is a 150,000 square foot office on East Jasty Road. Why do I like this story? Well, DSCR wasn't great, 1.21x. The property was valued at $40 million in 2015. So not a lot of value degradation, if you will, since 2015. And it underscores the fact that some people are willing to put money into the office space in 2023. Shall I go into the Greenish? Here we go. A couple of things. Laura Waxman again in the San Francisco Business Times. DocuSign renewed in San Francisco. The first bit of good news we've seen in San Fran in a while, but they're downsizing from 150K to 93K with the extension. They're at 221 Main in San Fran. In New Jersey Biz, Jessica Perry, who covers the New Jersey office market terrifically for New Jersey Biz, she announced that Avis Budget is moving its headquarters in Parsippany, New Jersey. Good news for Latitude, which is an office in Parsippany, 155,000 square feet. Bad news for 6 Sylvan Place, which is where Avis will be relocating from. And lastly, the mixed green that came out today, you know, it's good for some, bad for others. In Manhattan, 2 Sigma has renewed for 230,000 square feet in Soho. Why is that greenish? Well, the good news is that 2 Sigma is a tenant at both 100 and 101 Avenue of the Americas in Soho. So good on those owners for having 2 Sigmas stick around. The bad news is that 2 years ago, Steve Cuozzo was on the record for the New York Post as saying 2 Sigma was looking for 400 to 600,000 square feet in Manhattan, and they were a candidate to fill some real big empty spaces elsewhere in Manhattan. And now places like 1740 Broadway, where L Brands has vacated, they'll have to look elsewhere for that big new tenant. And that's all I have, Martha.
So just to piggyback a little bit on a couple of those greenish stories, Manus, the one there in New Jersey that came from the New Jersey Biz, the Avis Budget Group, they were the single tenant in that 6 Sylvan Place. So when you said, you know, that's bad news for them, that's really bad news for them because they were a sole occupant that's now moved out. So they're going to have to re-tenant that entire building. And then on the Laura Waxman story in San Fran Business Time, you know, that's great news that they extended, but their new lease size is about 60% of their old one. So, you know, in that market, you're happy to get anything. But if we were talking about this story really at any other time, you know, and somebody reduces their footprint by that much, that would be probably viewed as a negative on the whole. So just kind of speaks to where that market is on the macro, that if somebody signs a new lease extension, even if they're almost cutting their footprint in half, you're happy about that because you know the alternative is not great. So, you know, good stories, but I think there's definitely, even in the good stories when it comes to office, there usually seems to be a little bit of negativity attached to them.
And moving on to a couple of our shout outs, I will do these in sections. We have our Trepp Future Leaders undergraduate winners, and we had a number of people apply. So congratulations to the winners, Teddy Batesh and Noah Hakeem from NYU, Hudson Ardzione, I hope I said that correctly, West from Penn State, and Nabil Darmani from DePaul. And I'll mention some of the graduate winners next week, but congratulations. It's a competitive opportunity to highlight your accomplishments in school and internships, and quite frankly, just your affinity for the real estate and finance space. So those folks actually earned that award. And shout outs, let's start with the kids section of the shout outs, because apparently there is a growing group of kids that like to listen to the podcast. Jay and Vish came by to tell that Jay's son Ohm is a big fan with his dad. Andy S. met with Susie and said his kids, Ellie and Sophia, listen with him when he drives them to sports practice. And Bridget C. says her kids, Julian and Max, listen with her. So thanks, kids, for putting up with sometimes what has to be something that sounds like being in the classroom.
I have this image of the several of them already on their way to great careers in commercial real estate and maybe succeeding the three of us someday at the mic.
There you go. Listen, come on in, kids. We'd love to have you. And some of the CREFC folks, we had a lot of people reach out to us. So I'm probably not mentioning all the folks that we talked to. Todd, Joe, Three Dog Night, Shlomo, our San Francisco source who shared his sentiment about utilization, occupancy, and the office market. Jason K, Selena and Ann, Brian B, Tammy and Dave G, Dan M and Kurt S, Tony Y and Watson. We had a lot of fun with them, and Janie L as well. So there were other folks, but those were some of the ones that really stood out in terms of wanting to talk to our team. And some of our regular shout outs, Nick H loves the weekly podcast. Brad C reached out after our mention in the Business Sider and said, keep up the great reporting. We're going to need it this year. And from last week, Grant C on Twitter gave the podcast a shout out when we were talking about hashtag TWPT, which of course was a reference to the t-shirts.
And I'll throw one more in, CJ from South Carolina. Thanks for listening. And I hope you enjoy it. And thanks for reaching out to us.
And you guys know tomorrow's Friday the 13th. So I have a question for you. Do you guys suffer from triskaidekaphobia?
I don't. I'm not a very superstitious guy. And I'm so grateful that I didn't try to repeat that word. That would be tricky. I'm glad that this FAA outage did not come on Friday the 13th. That would have been a doubly worrisome omen. But I did like the fact that Orest said to me the other day that there's a poll out that says 75% of all men believe that if forced to do it, they would be able to land a plane under distress, like in the movie Airplane.
And in contrast, not even half of the women said they could.
See, I'm such an optimist that not only do I think I can land the plane, I think I'm going to have the opportunity someday. Like it's going to come my way. Like it just like someday shooting 79 in golf. Like I just think, even though the odds are probably even longer that I could shoot a 79 than that I'll be given the opportunity to land a plane, I still believe both will happen. I think that, sometime in my life that 79 is coming.
And for all the ladies listening out there right now, you're all just shaking your heads. I know it. And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thanks for joining us, Orest. Thank you for listening and stay well.
All right.